We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Steve St. Angelo of the SRSrocco Report. How are you today, Steve?
Tom, doing good. We've got a lot to talk about. It's been a very interesting year, so I'm glad to be back here with you.
It's always great to speak with you and glad to have you back as well. So a lot of the stuff we're going to be talking about today, I was able to pull from your premium service. And what I really like about your analysis is that you really look at the entire spectrum and how everything threads together. Your thesis really includes everything from the energy side of things and how that will affect everything down the chain, all the downstream effects, let's say. So why don't we get into the inflation? Everybody's talking about inflation right now. It's everywhere. And as usual, Steve, this is exactly why I appreciate your analysis. You're taking the opposite view that we are actually heading for deflation instead of inflation. So why is this?
You know, 5 years ago, I would have been along with the bandwagon that we're heading for all this inflation because the Fed is supposed to be printing all this money, and you hear it. You hear it on social media, you hear it on Twitter, the precious metal community, even Peter Schiff talking about money printing. But you know what, Tom? When the Fed is buying treasuries or taking treasuries from the banks, they're not printing money. They're destroying money. And so it's not money printing. QE is not money printing, and it's not inflationary. It's actually the exact opposite. And so what they're supposed to do is they're buying the treasuries, right? They take the treasuries, and by them taking treasuries off the market, the interest rate is falling. And that stimulates more borrowing for banks to loan people. That's why it's supposed to be stimulative. So the Fed is not really printing money. And now what I'm looking, I actually thought about this, Tom. An excellent analogy to understand the situation is like a hurricane. When a hurricane comes through one of these, in Katrina or one of these areas in the United States, all of a sudden everyone starts buying plywood, they buying water, batteries, and you see stuff getting wiped out. And they're not supposed to, but people start marking up prices. You could see plywood double. You could see water prices, bottles of water go up, gasoline, people are gouging gasoline prices. Now, is that monetary inflation? Or after the hurricane comes through, electricity gets back on, the trucks start bringing the plywood in, and the gas stations are full again, and there's no more demand for this. Do we see these high prices continue for another year? No, we don't. The prices go back down. Mm-hmm. And Tom, we're already seeing that. Look at lumber. Lumber was $1,800. Now it's $700. And also, I looked at IHS Market Research. They put a forecast out that the high-rolled steel, which is now $1,800, also a little bit more than that, they forecasted it may continue higher, but by the end of the year, they see it coming back down to normal prices. Mm-hmm. So this is basically the pandemic shut the economy, and then it turned it back on, and we have this kind of hurricane pricing. Now, there's other aspects like copper that will be in more demand due to the world going towards more green energy. So, and even oil. So there's certain aspects that are going to be they're going to have higher prices. But overall, that's the reason why I think we're going to see prices continue to fall. And we'll know over the next 6 months, we're going to see prices continue to fall.
So a lot of that is related to just the supply chains catching up. Is that correct?
Yes, that's exactly what it is. And, you know, I follow Stephen Von Meter, David Rosenberg, Lacey Hunt, and Jeff Snyder. And all four of them are deflationists. And if you listen to them, they all make excellent cases. And so if they are wrong, and if my thinking is wrong, we'll know it by the end of 2021.
Mm-hmm. So as you were saying, the way that the treasuries are working right now and that QE is actually deflationary, Steve, when we're thinking about that, would bank lending rates be a good indication of exactly what you're talking about?
Yes, and also the interest rate, right? Everyone said the interest rate's going to continue higher. Well, the long bond, the rates are going down. And I think we're going to see them really start to go down. So the bond market, the TLT, which is the long bond, and the long rates are starting to go down, and the long bond market price is going up. They're sniffing out that this is not going. They're sniffing out deflation or disinflation. And I'm not talking about this is going to last forever. Like they're talking about this pandemic, inflation is going to last forever. Once we go through this kind of falling prices, there's also going to be issues with energy that we're going to see higher prices. And in the future, we're probably going to have hyperinflation. Mm-hmm. So I do see that coming in the future.
So what's your timeline, Steve? How long are we going to see this, let's say this deflationary era last? Is that about a year? And then from there, we're going to start to see this hyperinflationary phase as you're talking about?
Well, I think we'll start to see it by the end of 2021. And then you got to remember, all this money, we have to remember that 75% of the money that was sent to stimulus, that was sent to Americans, 75% went to pay down debt and is still savings. Only 25% went into the market. Mm-hmm. And so that's not inflationary. So the thing is, I think you're right. About 6 months, a year, we're going to see falling prices, a consolidation. But we have to also remember the stimulus is no longer going to come into the market. So we're going to have worse economic activity. We're going to have more people hurt with jobs, more small businesses go under. That dynamic is still playing. So we're going to have weaker demand by the end of 2021 and into 2022. So I think we're going to see asset price deflation at that point, stocks, and maybe even real estate starting. But the hyperinflation will not probably happen for several years. That's probably maybe 3 to 5 years away. I still think it's about, and that's going to also happen with the energy cliff, this energy system problems that we're going to face.
Mm-hmm. Yeah. And we'll get to speaking about that, Steve. But if we think about QE as being actually deflationary, then why is the stock market going up? Is that more just trader speculation, believing that inflation is coming?
I actually sent Stephen Von Meter an email question about that. Because he said, is this money that the banks buy treasuries because they're getting all this deposits? So they buy treasuries. Then the Fed takes those treasuries, puts it on its balance sheet, and gives the banks a small percentage rate. Mm-hmm. And so people think, well, they're taking that money and putting it in the stock market. Well, Stephen Von Meter and I agree now, they're not doing that. So we also have to remember, what did the last chart show? Homeowners in the United States are most exposed to stocks ever. It's 28%. It's even higher than it was before the 2007 financial crisis. And it was even higher before the 2000 tech bubble. So the thing is, yes, what's driving the stock prices higher is stock buybacks, is speculation in that we're going to have inflation.
So as you're speaking to Stephen Von Meter about this, what is the liquidity trap and what does it have to do with this situation?
We have to understand, when you look at the M2 money supply, we all see it's skyrocketed, right? Mm-hmm. Actually, I looked at the numbers today just to make sure. It was 15.5 trillion before the pandemic. It's now 20.4 trillion. It's up 4.9 trillion, almost 5 trillion in just a little more than a year, right? Mm-hmm. So people thinking that's money printing, it's not, because the M2 money supply does not include all the M2 US money supply overseas, because we realize a lot of currency in circulation, a lot of $100 bills are overseas. Mm-hmm. A lot of money supply that's in the digital banking system is overseas, but it's not counted. So we're not printing that M2, we're borrowing it. Big difference. And so what's happening, get these numbers, the Fed's balance sheet was 4.1 trillion before the pandemic. It's now 8.1 trillion. So if you think the M2 money supply increased 4.95 trillion since the pandemic, the Fed's balance sheet is up 4 trillion. It has taken 4 of that 5 trillion and parked it on its balance sheet, which suggests that the money velocity, well, we'll get to that. Mm-hmm. So that's a liquidity trap. A lot of this money supply has been taken out of the market and put on the Fed's balance sheet. That's not inflationary. The only way it can be inflationary if the Fed starts to taper and banks start lending, and they're not doing either of those. Mm-hmm.
So when we think about the term inflation, the Austrians define it as an increase in the money supply. So are we talking about asset inflation here or consumer price inflation?
Well, you see, the Fed and some of these, David Rosenberg, a lot of prices are going up. Mm-hmm. School prices are going up, healthcare is going up. But if we look at oil, oil was $25 back in 2000, and now it's $72. Mm-hmm. It's gone up, but it's less than it was. It was $100 for 3 years, over $100 for 3 years. It's 25% less. So the thing is, we have to go by what the energy prices are, even though that's not in the CPI. But I do think once you start getting out all the problems with the pandemic and all the supply chain issues, the inflation really isn't that high. The inflation really isn't that high. Yes, even though there's still the debt in the system and the Treasury is issuing more treasuries to cover the deficit. Yes, all that is happening. But really, the inflation is not skyrocketing like it was in the 1970s. Mm-hmm. And we can see that in the money velocity.
Well, that was actually my next question is if all of this currency is being parked on the balance sheets and we're seeing savings rates increase, this is all negative for velocity, right?
Yeah, because, you've got to borrow money. It's like when you go to the store and you get a credit card and you buy $2,000 of a new big screen TV, you just created $2,000. And you're going to pay that over, let's say, 12 months or 15 months. You've created it. But let's say you bought that, right? And then the pandemic hit, and Uncle Sam sends you money, and then you go pay that off. You just destroyed that $2,000 of money supply. Same thing with loans and all these different things. If we look at the M2 money velocity, before the pandemic, the ratio was 1.4. All right. So it was $1.4 trading for every one. Well, you know what it is now? It's 1.1. Wow. We've lost 0.3. And guess what? Since we've been doing QE since 2008, the money velocity was 2.0 in 2007. It's now 1.1. QE is destroying the money velocity. And it's also destroying the economy at the same time. Because if you look at the money velocity and you look at the long-term labor participation rate, it's almost, they trending exactly. So the Fed's QE policy to try to keep this U.S. economy from imploding is slowly destroying the economy. That's what it's doing.
Yeah, and I know I've looked at the chart of monetary velocity before, and it's quite dramatic. It's basically fallen consistently since the 1980s, right?
No, it actually went up, but then it's been falling since, I would say, about 2000, especially since about 2000. But when you look at the huge increase in the M2, and then you look at the money velocity, they're going up in the exact opposite direction. And that's why, because the Fed has taken $4 trillion of that off of the market and parked it on its balance sheet.
Mm-hmm. So, Steve, looking out a bit more long term, how does the energy cliff fit into your thinking on this deflationary trend? And if you could just remind us of what your thesis around the energy cliff is.
Tom, that is a 2-hour interview right there. And, maybe next time we can talk about that. The energy cliff is, we saw an energy cliff, right? It was a pandemic-induced energy cliff. Mm-hmm. Global oil demand went from 100 million barrels a day in 2019 down to 91. 9%. That's how much it fell. That was a cliff. What is going to happen now, because the falling energy return on investment, we're now tapping into very expensive oil that's not profitable like shale. We have increased a lot of shale, but now the bust is now here. And so the issue is Russia is now dealing with peak oil. The Middle East inflated their oil reserves in the 80s to increase their exports. The problem is we're going to start seeing oil production really decline over the next 5-10 years, especially in 15 years. And the world is going to be a much different place. And without oil, nothing else is possible. And that's the problem. You need oil to extract coal. You need oil to drill shale gas wells. You need oil and coal and natural gas to make solar power panels and wind turbines. Mm-hmm. So when oil gets into trouble, everything else does. And no one understands that. And let me just tell you, that is inflationary. That is going to be inflationary for energy and goods. It's going to be deflationary for asset values. stocks, and real estate. Because when you have less traffic, it's going to destroy the economy, value of commercial real estate, which also is in the crapper. And it's also finally, the energy cliff is really going to impact real estate prices negatively. And bonds are going to get hit soon. Because you got to remember, a 30-year bond, you have to have 30 years of growing economic activity to pay off a 30-year bond. And if energy production is falling, you're going to have falling economic activity.
So will that long end of the curve start to creep up as well to the shorter end of the curve, Steve?
Yeah, because I think the longer inflation, the interest rate will finally start going up. But when it does, the nearly 400 trillion, I think it's 375, 380 trillion now of global debt, that gets into trouble. Mm-hmm. You can only maintain that amount of debt if you increase oil production. Energy, if you can't and it starts to really fall, that's when 9% of energy came on, that's why the world had to add all this debt to keep the system from collapsing. Mm-hmm. So, but if the debt bubble bursts, then you're going to see real interest rates. That's when you're probably also going to see hyperinflation.
So, Steve, the last time we saw this dramatic inflation in the US was in the 1970s. So, just as one example, how did the price of oil affect the profit margins of gold miners if we compare them from today to 1979?
Before I get into that, a frame of reference, and I did a Gold Member article on this, the 70s inflation was all due to oil price shocks. We had the Saudi Arabia oil embargo in 73, and that quadrupled the oil price. And then things kind of remained calm, Tom, for about 3 years. Mm-hmm. And then we had the Iranian Revolution in 79. And that's when the price of silver and gold shot up because what? Guess what? The oil price went from $12 to $38, actually $36 in just 2 years. And that's why the price of silver went up. That's why the price of gold went up. But if we look at the home stake mining, their cost of production was $41 an ounce in 1970. They were losing money when the price of gold was $40 in 1971. But they were making good money by 1980. But it was because the price of gold was going up because the cost to produce it was going up. And I think that's what people need to understand. And so guess what? Home stake mining's cost of production in 71 was 41. By 1980, it was $267. But it got $612 per ounce of gold. So its operating margin was 55% that year. And so that's the kind of the reason why the price of gold fell. The margins were so high. And then Volcker came in and reined in the inflation. And so that's the thing. And if we compare it to now, the gold miners now, they're making between 30 to 40% operating margins. They're doing pretty good. Mm-hmm. So it's Barrick and Newmont are making between $500-$600 an ounce profit. And so the thing is, they're making excellent money. And even the silver miners are making like about $7 to $8 an ounce. Mm-hmm. You know, a couple of years ago, the silver miners were barely surviving. And back in 2016 and 17, the gold miners were making maybe $100, $150 an ounce profit. Now it's 3 or 4 times that.
So in this way, Steve, does the price of oil dramatically affect the price of gold because of cost input?
Yes, because people say, well, no, you got it all wrong, Steve. It's not the cost. It's if no one wants to buy gold, then it doesn't matter what the cost is. Well, that's true. You have to have some demand. Mm-hmm. And so the thing is, well, people have, we're demanding about all the gold there is. And so let's forget that. And so you have to look at the cost of production, because what happens if the price of gold was $600 an ounce? That's what it was today. Mm-hmm. Well, the whole gold mining industry would go bankrupt because nobody could produce gold at $600 an ounce. Mm-hmm. So what can they produce it at? About $1,150, $1,200. That's what they can produce it at now. That's full in costs. And so is that the floor? Well, kind of, because that's what it takes the gold mining industry to produce gold.
Mm-hmm. So is there another analog to this energy cliff that we're talking about in history that really informs your thinking on this, Steve? I know the last time we spoke, you were just starting to research the Bronze Age. So what parallels can we pull from that example to today?
Tom, I had no idea the amount of wood. You see, what we use for energy today is oil natural gas and coal. Those are it. You know, the nuclear and hydro and renewables, they're about a quarter altogether, maybe even about 20%. So it's oil, natural gas, and coal. That's what our energy is. And then you've got human labor. Well, back during the Bronze Age and during the Roman Empire, it was wood. And let me tell you, during the late Bronze Age, and what's fascinating about the late Bronze Age, it is very similar to today. You had 8 different empires, all trading in the Mediterranean, in Egypt, the Babylonians, the Mycenaeans. They're all trading with themselves. It was highly complex for itself. It was very interwoven because the Bronze Age needed copper and tin. And they had all these different things they traded. And tin was coming from Afghanistan that made it all the way to Cyprus and these other places so they can make bronze. And so the thing is, what did it take to produce copper? Well, towards the end of the late Bronze Age, I estimate over a 50-year period of time, in the late Bronze Age civilizations, there were 8 empires. 160 million trees were cut down to make charcoal to smelt copper. And that's not all. They also did pottery. They also had to smelt tin. They also smelted gold and silver. They also made lots of ships and built homes. And so it could easily be 500, 750, a billion trees were cut down. That was the wood that drove the economy. And guess what was the collapse of the late Bronze Age? It is the falling energy return on investment of the wood. They basically ran out of easy to get to wood, and that was their fuel. And that's the exact same problem that we're dealing with today. We're running out of the high quality energy return on investment of oil. And once we start to peak, then we're going to have the same problems that they've dealt with the late Bronze Age.
So when we start to hit this energy cliff in oil, Steve, I remember speaking with you about this last time. So what is going to happen to the price of oil? Won't we see higher prices for a commodity that is becoming more scarce?
Yes, we can. But if we go back to the late Bronze Age or even the Roman Empire, you have 2 things happening at the same time. And they didn't have this amount of debt. You see, the big difference back then is we have this huge financial system that they really didn't have back then. Very complex, global, digital financial system, all this debt. When the debt starts to fall apart, a lot of the assets fall apart and it's deflationary. And a lot of that oil cannot be produced that's in the ground because it's only being produced because of the debts kind of holding up the system. So we've run through the easy conventional oil. Conventional oil has peaked. We're starting to see a decline in conventional. We have made it up with oil sands from Canada, tight oil, shale oil from the United States, and deep water. All those are very expensive. And the shale oil industry, I think we're going to see most of that collapse over the next 10 years. Most of that shale production is going to be gone because we're running out of drilling locations. So the thing is, even higher oil prices, the economy can afford it. Because when you have falling oil production, which we're going to start to see, you have less employment, less jobs, less people can afford the oil. Yeah, we're going to see oil prices go up, but then they're going to fall. It's going to be volatile. The issue is this, it's the falling energy return on investment. Our high-tech global economy needs something above 10 to 12 to 1 energy return on investment. That means about 12 barrels of oil have to come for 1 barrel of energy that goes into extracting it. Shale oil is 5 to 1. Tar sands or oil sands is like 4 to 1. Conventional oil back in 1920 was 100 to 1. You cannot change those numbers. That's why there's all this debt being added, Tom, because the energy return on investment of this quality of oil is too low to maintain our high-tech infrastructure system. So we can't go get methane hydrates. Yes, Russia is in the Arctic trying to get the Arctic oil. Very expensive to do that. You see, that's not, well, we got a whole new 100 years of oil. That's the retirement party. Shale oil is the retirement party. Heavy oil is a retirement party. Deep water, that's a retirement party. That doesn't mean we're heading into a whole new system, a whole new oil age. We're at the end of the oil age. And that's why we're going to start seeing steep declines in the future. And that's going to be bad news for most asset values.
So how does that energy cliff, Steve, really play into really what comes next? You mentioned that the higher oil prices, the economy can't support it. So what happens at that time?
It's kind of like, the price of oil went to $147 in 2008. Mm-hmm. Conventional oil production peaked. And then we brought on shale oil. And people don't get this. People think, who saved the economy was the Fed money printing. No. You know why? Because people say the same thing, go back to the Depression in 1930s. They said, well, the Roosevelt's New Deal got us out of the Depression. Or some say, well, that really didn't help. It was World War II that got the U.S. out of the Depression. No, it wasn't. It was the oil production. We had the roaring 20s because the United States doubled its oil production in a decade, doubled it. We were building cars and tractors. We were doing all this wonderful stuff. That's why there was the roaring 20s. The reason why we were able to pull ourselves out of the financial crisis in 2008, Tom, because the shale industry brought on 8 million barrels a day of shale oil. It's not the money printing or the money stimulus that brings you out of a depression or the recession. It's the energy. You got to back it up with the energy. So this is the problem we're facing. We're heading now with more debt than ever, more leverage in the market than ever, and we are not going to have the same 10 million barrels a day of oil production growth in the next decade. I believe it's over. We may get back up to 100 million barrels a day, but they're going to start to decline. And you can't have growth unless you have oil production growth.
So in a way, Steve, just to really distill this down, you're saying that the energy is basically equal to growth or GDP and monetary velocity. So as we produce more energy, we're able to produce all kinds of other goods, which in turn stimulates the economy, right?
Yes. And people are going to say, well, we don't need as much energy to do GDP. Well, yeah, because you got debt, because you have debt now.
And that almost in turn, the debt in the system and the falling energy supplies act as headwinds to this continued growth.
Yes, because John Kovici did this wonderful presentation in front of the OECD back in 2019 showing oil production growth and per capita and GDP growth per capita. And they go up together and go down together when you have declines and recessions. And so it's changed it because we're adding so much debt to prop up the GDP. And so that is the problem we're facing. You cannot have economic growth unless you have GDP growth. And this funny thing, I think I may have mentioned this, but I want to repeat it. When the pandemic hit on the financial networks, everybody was working from home. And I remember watching CNBC, and they had 4 analysts on the TV, all working from home. They had split screens. And so they asked him, and one guy goes, you know what, look at energy, because energy really was bad last year. It went negative. No one liked energy last year. He goes, I don't care about energy. Why? Because it's only 2% of the S&P. And then you see technology is 26% of the S&P. But you have no S&P without that 2%. You can't run the economy on technology. Technology is run on energy. And because the supply chain and the infrastructure is so complex, people have lost touch. Technology doesn't create more energy. That's a facade. It actually uses more energy. So even though we're using a lot of technology to produce shale, it doesn't change the energy return on investment. It actually lowers it. And so that's the problem. You can't run an economy on technology. You only can run it on energy, and there is no plan B for energy.
So, Steve, you and I have spoken about exactly what you just mentioned about this global supply chain. So can we talk a little bit about that and maybe use the semiconductor industry as an example here? I've read somewhere that there's something like 20 countries that are involved in producing one semiconductor. So is this a good example of this global supply chain starting to break down as we're seeing everybody starting to wait for these semiconductors?
Yes, you see, as Joseph Taylor said it wisely in his book, The Collapse of Complex Societies, a gauge to know when a society is starting to get ready to collapse is how complex it's getting. So when someone says, all we need is just smart technology to fix our problems, It's like saying, I just need a better drug to help me with my drug problem. No, you just got to stop taking the drug. You can't get a better drug. You can't have more technology to fix a technology problem. It just makes the situation worse. And so what is the epitome of high complex is the semiconductor. And if you look at the clean rooms, Tom, I'm putting together an extensive presentation. I did the Bronze Age collapse, how it compares to the modern era. And the semiconductor is the problem that we're dealing with because now everything's run by computer and semiconductors. And so I think it's more like 40 countries. That's the problem. And a semiconductor will travel 25,000 miles before it gets into a product. Or by the time the product ends up on the shelf, it goes 25,000 miles. And so no one gets that. And the problem is, you could tell the semiconductor is towards the end of this high complex society because it's got the highest research and development in everywhere. It's 22% of the money goes into research and development every year. I mean, do you know what's next is the pharma and biotech. And then capital expenditures are the highest. It's 26%. So when you add those together, these companies are spending 50% on research and development and capital expenditures because the stuff is changing so fast. When you see something changing faster and faster, that's not a good sign. That's a bad sign. You want slow, you want consistent. But when you see things change so fast, people are kind of amazed by it. Tom, that's a bad sign because that kind of gives us a gauge, a red warning sign that this is not sustainable. And so, yes, when energy gets problematic, the whole global supply chain is going to start to break down, and you cannot produce semiconductors unless you have a functioning global supply chain.
So, Steve, I'd like to turn a little bit now to the metals. You and I spoke last time about India and how much silver that they import. So you also have a very dramatic chart that you've put together about Indian imports falling to unbelievably low levels. So why is this?
Well, you see, I didn't know this. I did the research on this. A lot of gold buying is done more in the city, and a lot of silver buying is done more in the rural areas where the farmers are. And get this number. Your listeners are going to, I was blown away. 80 million Indians are farmers.
Wow.
That's amazing. That's 57% of their population of 1.4 billion are farmers. Now, compare that to the US, 2.6 million American farmers compared to 330 million US citizens. So it's 1.3%. The COVID lockdowns really hurt the farming community. And now, because there's a lot of issues, the Modi government is doing some changes, and there's a lot of farm protests. I mean, a lot of farm protests. These poor farmers are barely breaking even. And so the Indian imports have fallen for silver because two reasons. Because of the COVID impact, the farming community, they're barely surviving. They don't have the money to buy silver, and the price of silver has gone up. You usually buy silver when the price goes down. But here are the figures you're talking about. I went back and looked. The peak year was in 2015. India imported 8,500 metric tons. Tom, that's 275 million ounces. If you average it from 15 to 19 before the pandemic, India was importing about 6,000 metric tons a year. That's about 190 million ounces. Guess how much they've imported in the first 5 months? 95 metric tons. Their average monthly imports over the 5 years is 500 metric tons a month. It's 95 for the entire year. So far. Yeah. And now, I think March is estimated about 32 tons. And typically it's anywhere between, the lows are 150 to 700 tons. And they're importing between 10 and 30 tons a month. And they are a big component of the silver market. So I think we're going to see some different changes take place. Some of the dynamics in the silver market have changed, like the US Mint. They're doing their silver and gold eagles. They have new designs, and they're doing anti-counterfeit designs, just like the Canadian Mint has done. They're having issues. It's been 2.5 months and they haven't sold any more product because I think they're going to come out in July finally. So there's about 2.5 months of Silver Eagles that were 3-4 million a month that have stopped. I think it's going to pick up again. So there's been some interesting changes, fundamental changes that have happened in the silver market.
So we can kind of look to if and when this demand comes back online to possibly help the price. Is that a good way of looking at it?
Yes. And my stance is the energy cliff is going to make gold and silver demand like you've never seen before. And so as the market wakes up, because asset values are going to fall, stocks, bonds, and real estate are going to get into serious trouble. So the mid to long term fundamental is the prices of the metals are really going to go up because there's not that many of them. And that's the real store of wealth. But before then, we're going to see some volatility. But I do believe if things start to function again better, and we could see more Indian demand pick up by the end of the year.
So, Steve, when we're not speaking about India, in the West, we've seen a major inflow into the ETFs, these silver ETFs in US and Canada. So has this replaced some of the demand from the lack over in India?
Some, the whole ETF thing, there's a big debate whether there's a manipulation that JP Morgan has all this silver. I really don't care. But the issue is there was 331 million ounces of net silver ETF demand in 2020. Physical demand was only 200 million. ETF demand drove the price. Mm-hmm. To me, the future, one of the big key indicators is going to be ETF demand. Because when you start people waking up, institutions waking up, if they go into ETFs and JP Morgan can't get the silver, and they have said that, they have warned in their updated prospectus, if we can't get the silver, what does that do? That pushes up the SLV price up higher because they can't get the silver to back up the demand. And so that's going to start causing a lot of dislocations. More and more people are going to wake up. So it's actually a good thing that investors move into the ETFs. Here's what I've saw, Tom, since the end of 2020 to now, my estimate is we've seen a net increase of about 100 to 120 million ounces of ETF demand, and basically none from the iShares. It's mostly been Sprott, it's been ZKB, it's been the ETF securities. It's also been Deutsche Bank. Deutsche Bank has seen about 12 million ounce increase because Germans now are interested in getting into silver. And so it's about 100 to 120 million ounces. Well, if you figure that the average import for India is about 190 million ounces a year, it's making up some of it, but not all of it. But we are still seeing high demand for bars and coins in the United States and in Canada and elsewhere. That's still elevated.
So if we look at the quarterly price chart for silver, Steve, what moves do we need to see to confirm the price moving higher or lower?
Tom, the magical number on the quarterly chart is 27.5. By God, if you look at the chart I show, 4 quarters, silver has tried to break above 27.5. It did, and close above it. Mm-hmm. Because if you go back in 2011 and 2012, that's where the support was at 27.5 on a quarterly chart. Again, a quarterly chart's 3 months of trading in each candlestick. So there's been 4 attempts in the last year to get above 27.5 and close. And today is the last day of this quarter. And silver looks like it's not going to close above it. So it looks kind of bearish on the short term for silver. And I think, let's forget the manipulation. If we look at these fundamentals that I'm talking about, Indian demand is basically dead in the water. I think that this may be some of the fundamentals that are working in the silver price. For the silver price to break out new highs, we need to see a substantial break above 27.5 and close above the 27.5. And earlier last year, I thought we were going to do that. But if you look over this past year, Tom, we did not stay above that 27.5 level. Now, people can say in the precious metal community that it's manipulation. That's fine. Maybe it is. But I think we're starting to see weakness now in some aspects of the silver market that suggests why the price is acting this way. And also, look at lumber. I mean, people are still demanding lumber, but the price of lumber went from $1,800 to $700. Is that manipulation? I don't think so.
So when we're looking at this type of candlestick chart, Steve, if most of the wicks are at the bottom of the body, what is this showing us?
Yeah, if you look at this 50-year chart I have of silver going back to 1971, there are 4 times that have these bearish candlesticks. In 83, in 87, in 2011 and 12, and now. And I've got circles around them. And what happened after we had these 3 or 4 quarters of these bearish candlesticks where the wicks are at the top? That means the bears are kind of winning and the body of the candlestick is at the bottom. What happens? The price tends to be weak after that. Now, some may say you can't go by that. Well, let's see, right? We've done this interview on June 30th. So let's see what happens by the end of the year, if it's proven incorrect or in 2022. Again, this is just short term. This is just short-term movement because there's 2 dynamics taking place in the market. I think we're going to see some of the highest silver prices in the future, but we're still going by a system that is run by the central banks and the Fed and central banks. And until the energy cliff really starts to hit, we're not going to get those real big moves in the precious metals.
So, Steve, when you're talking about the manipulation here, is your technical charting still effective in a manipulated market?
I think so. You know why? I've got a chart of Barrick Gold and Newmont since 2000. I've got the price of their cost of production and the gold price. Now, for every year, and do you know the gold price never went below their cost of production? And now they're making $500-$600 profits an ounce. And let's say they are manipulating, okay? Okay, let's say the banks, because this is when you look at a lot of the precious metal community, when you see a big fall in the price of gold or silver, that's a banker smash. Now, if the price shoots up, that's real trading. And so if it goes down fast, it's a banker smash. But I looked at the operating margins of some of the top Dow Jones industrial stocks. McDonald's was 41% in the first quarter. That was their operating margin. Well, you know what Rio Tinto was? 44%. BHP Billiton was 38%. Do you know what Barrick was? 38%. Well, if they're manipulating the gold price down, well, Barrick is making pretty good profits. Apple is 31%. Do you know what Fresnillo, the biggest silver producer? It's 30%. Now, if you want to see something that if there is manipulation, Chevron's operating margin last quarter was 5%. So we have to understand they're valuing the metals as commodities. So if we really believe they're manipulating, let's forget the money printing and the debt. If they're really manipulating the metals, then they wouldn't have these margins. Now, if we're talking about gold and silver as a store of value, that's a totally different thing. And yes, they're kind of manipulating the market. Why? Because 99% of investors, Tom, are in stocks, bonds, and real estate. Do you think the Fed and central banks care about the 1% invested in precious metals? No. They're concerned about the top 1%, but they're also concerned about the 99% who are in stocks, bonds, and real estate. They're going to manipulate the market to keep that system going. And guess what? The energy cliff is going to pull that from underneath them. The money printing is not going to help, or the stimulus, or the QE, or whatever. That won't help anymore because you can't do it when oil production and energy falls. That's when the manipulation of the metals are going to end, because the market is going to wake up from thinking that asset values are just in stocks, bonds, and real estate. Mm-hmm. They've been trained to believe that. So they're going to wake up that it's not really a store of value. And that time is coming.
So Steve, when you were talking about the operating margins of these gold producers, if you look at that, let's say, entire sector, does that mean to you that the gold miners are severely undervalued at this point, considering those operating margins?
Well, actually, you might say they're overvalued, right? Because they're operating. Now, here's what's interesting. During the 1970s inflation, homestake mining lost money in 1976. Their production cost in 1976 was higher than the gold price they got. So this idea that during the 70s, gold price and silver went up, it really spiked in 73 and 4 and 79 and 80. That's where the big spikes were because of the energy. The gold price started to fall in 76, but homestake's cost of production was still high. They lost money. So their operating margin was a negative 6% compared to 1980 when it was 55. If we're just looking at the market the way it is, and Barrick is making a 38% operating margin, where you go back, let's say 4 or 5 years ago when it was maybe 10%, they're doing pretty good. You might say that the gold price, if it fell, they're still making money if you're looking at it as a commodity. So that's the way the market is kind of looking at it. They're not looking at gold as a store value. They're looking at it more as a commodity. Only 1% of the people buying the precious metals are doing it as a store value.
So, Steve, considering all these factors, are we going to continue to see this, let's say, sideways kind of choppy pattern for the rest of the year? Or what is your outlook for the gold and silver price for the rest of the year?
Well, if these deflationists are correct, and I think they are, the second half of the year, the demand is going to start to fall because there's not going to be the stimulus. And a lot of people who are on rent forgiveness, or they don't have to pay their leases for their small commercial building, when they have to start paying that, or people have to start paying their mortgage, or most of the states stop giving people $300 a week. When all that happens, is that good for the economy? No. And so what's going to happen, you're going to have a weaker economy. And so I think demand is going to get even weaker as the supply catches up. And I think that's when we're going to start to see a correction in the stock markets into the third quarter, fourth quarter. And so I think we're going to see lower prices. We're going to see even low energy prices because more people aren't going to be driving as much. And so I think that's what's going to happen. And into 2022, we're going to see even more of that. So I think that's kind of my target for the next 6 to 12 months, unless there's some geopolitical event that turns things upside down. That could always happen. Mm-hmm. But let's say that doesn't happen. We got to keep an eye on the oil price. If there are oil price shocks, it could impact like the metals prices. That could happen. But to me, over the longer term, I think we're going to see more weakness in the economy, and oil demand may even be softer by the end of the year.
So that'll also extend to the metals in this next 6 to 12 months here of decreased demand.
Yeah. I have prepared the SRSrocco Report subscribers. They have known now for several months. I've looked at the COT reports for silver. I said, look, the commercial net short position is kind of at a high. And we had the big sell-off last week, and we saw a liquidation in the commercial net short position. Well, I don't think it's over yet. Mm-hmm. And so the thing is, if we forget all the manipulation and all this and look at the economy, if it is going to get weaker, that means less demand for things. And so that means commodity prices are going to fall. We could see problems with food. That might be different if there's shortages of food. But I think overall, we're going to see declines in asset prices and metal prices. And that will start to change as we have issues with energy going forward. That's when you're going to start seeing spikes in oil, spikes in commodity prices and energy. But here's the thing, the energy cliff is going to put higher pressure on things we consume, and it's going to put lower pressure on things we own, like cars and houses and stocks. And so that's the dynamic that's going to play out in the future.
Excellent, Steve. Do you have anything else you'd like to share with our audience before we wrap up here?
I think if you listen to analysts and they don't talk about energy, you have to question that analysis. Even these deflationists, Tom, that I admire, because I think they got the short term right, I don't think they understand the energy. Mm-hmm. And so, they think, well, we're just going to have the business cycles are going to continue. You're going to have business cycles forever. No, when the energy cliff hits and we start going down in oil and there's no plan B, the business cycle is dead. We're going to transition. This is my new theme now. We're going to transition from building wealth to protecting it. You can't protect it with real estate, really. And so this is what I think it's important. I think your listeners should really understand the energy because the energy drives everything. Without the energy, there's no economy. And if you understand that, that should be your number one factor to base all your analysis on.
Absolutely. All right, Steve. Of course, you're available on Twitter at SRSrocco Report and also SRSroccoreport.com. Anywhere else you'd like to point to?
Yeah, I still do some public YouTube videos. I try to do at least 1 or 2 a month. And we do have free articles at the website, but there's a lot of excellent information for subscribers. And I think when you understand the details of the energy and we try to put out data you can't find anywhere else. I really enjoy what the Wall Street silver guys are doing, trying to get more people to buy silver. But we have to understand some of the data that's taking place, and we try to provide that information. I'm not just going to say manipulation's happening. I'm going to provide this information, this data that not many people get to see, and that can change your mind or make you understand what's happening better.
Excellent, Steve. Well, I really appreciate you sharing your analysis and all your research with us today.
Well, thank you, Tom. Maybe we can get back again in the third quarter or fourth quarter and see what's changed.
Absolutely, we will. All right, Steve, thanks for your time today.
You too. Have a good day.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.